The stock market, in some capacity, is believed to have existed as early as the 1100s. But it's more widely accepted that the first stock market system, similar to our modern version, was established in the 1500s in Antwerp, Belgium. This was the first time a singular location was used to host trading between merchants, though even then they really only traded commodities such as crops or precious metals. Sometimes debts were traded as well, but at the time, a debt was just a promise written on paper. Actually, now that I think of it, modern debts are still just promises written on paper, just more complicated. Anyway, one key ingredient was still missing, and that was actual stock. When you say that you own stock, you're probably referring to a portfolio containing multiple shares. A share is a financial security that represents ownership of a tiny piece of a single company. Anyone who owns at least one share of a company is considered a shareholder, and their stake in the company is the percentage of shares they own out of the total shares that exist. Take Gary here, for example. He listens to NPR every morning, and he's watched The Wolf of Wall Street at least a dozen times, so he's pretty much an expert. He downloads Robinhood on his phone, deposits his rent money, and buys 2 shares of Tesla. You may be thinking to yourself, why Tesla? And the answer is simple. Elon Musk is a god, and flamethrowers are cool as hell. Now, as a shareholder, Gary may be entitled to a portion of Tesla's earnings, or he could receive the right to vote on future decisions. Also, however unlikely it may be, should Tesla end up in liquidation, Gary could even receive a portion of the remaining company value. The full details of Gary's relationship with Tesla are primarily determined by the type of stock he buys. Shares come in 2 main types, common stock and preferred stock. Common stock is also known as voting shares or ordinary shares. As the name suggests, they typically grant the shareholder voting rights in corporate decision-making. I say typically because although a lot of countries have laws requiring common stock to include voting rights, some of them don't, including the US, where a non-voting series of common stock can be issued, the irony of which is truly outstanding. Preferred stock, on the other hand, is almost never issued with voting rights, but it does generally pay out higher yields to the owner. Let's assume Gary owns preferred stock, because the idea of Gary having any influence over the future of Tesla is too horrifying to even hypothesize. How does Gary get that juicy return on his investment? The answer to that is dividends. Dividends are payments made periodically by a corporation to its shareholders. Usually they're paid via cash or check, but a company can also choose to issue additional shares instead. They are generally on a fixed schedule, which can range from monthly to annually. Special dividends can also be paid at any time the company sees fit, even if it's outside their regular schedule. An example of this would be if earnings were significantly higher than expected for a given period. The company could decide to give a bonus dividend to reward shareholders for their support. This massive flex also strengthens the image of the company, basically saying, we don't need it. So, by now, you're feeling pretty amped, right? I mean, if Gary can be an investor, anyone can. You saw on Facebook not too long ago that that football star from your high school class started a company selling gluten-free vegan protein powder, and you want to get it on the ground floor. I mean, it's got avocado oil and it's GMO-free? You don't know what a GMO is, but there's no way this can fail. You open up Robinhood, like all good investors do, but to your dismay, your buddy's company Protein is nowhere to be found. You decide to time travel back to the 1970s, figuratively of course, and phone a physical stockbroker so he can buy the shares for you. He's shocked, mainly because that phone hasn't rang in like 6 months, but he regains his bearings and picks up. After a little research, he apologizes and informs you that he can't buy you shares of Protein either, because it's not a publicly traded company. You ask your broker if he'll invest your money into Dogecoin instead, but you get suddenly disconnected. Oh well, you can call back later. Now, why couldn't you put your life savings into Protein? Well, it turns out that just because a company exists doesn't mean it has stock. And even then, a company can have stock but still not be listed on an exchange, meaning you still can't buy shares even if you want to. There are pros and cons to each status. So let's talk a bit about why a company would choose to be private or public. Initially, all companies, at least in the US, start off as privately held. This includes sole proprietorships and partnerships, limited liability companies, and fully incorporated operations such as S Corp and C Corp. A privately held company is simply a company that has not offered shares to the general public. The current owners or a selected board of directors maintain full control of all business decisions, and the financial performance of the company is mostly allowed to be kept undisclosed to the public. With this autonomy comes a few drawbacks though, namely with raising capital. Sole proprietorships partnerships, and LLCs are all restricted from issuing stock or bonds. If they want to raise funds, they either have to bring on additional partners or members or take out a business loan. Meanwhile, incorporated businesses can seek funding through issuing shares to private investors, as well as incentivize employees by awarding shares. However, depending on the type of corporation and the company it resides in, there may still be limitations on the total number of allowed shareholders. Now don't get me wrong, there are some massive companies that exist today that are still operating as privately held entities, which for some reason includes an obscene amount of grocery stores. My theory, if they weren't private, common stockholders would selfishly vote to offer multiple free samples to every customer, ultimately leading to bankruptcy. Now, although some big names make the private list, in the grand scheme of things, it's pretty rare. Generally, when a business exhausts the growth that they can achieve strictly through private funding, the next step to expansion is to convert to a publicly held company, also known as going public. This can be achieved in one of two ways, the first being an initial public offering or IPO. This is where a set amount of shares are sold to institutional investors such as banks, hedge funds, etc., and sometimes also individual investors. The entire operation is underwritten by one or more investment banks, who buy all of the offered shares at a discount to redistribute through their own networks. If the IPO is especially attractive, the underwriting banks may reserve all of the shares for their cool kid billionaire clients, leaving nothing for individual investors. Now, the underwriting banks earn their keep. They generally handle paperwork, drum up hype for the IPO with their clients, help set the initial price, and even arrange for the shares to be listed on the public stock exchange. Now, this all sounds great, but an IPO can actually be very expensive and time-consuming for a company. Due to all of the fees and man-hours associated with setting one up properly, cost is often a barrier keeping smaller businesses from going public. Alternatively, instead of an IPO, a company could choose to engage in a DPO, which is a direct public offering. A DPO is cheaper and faster than an IPO, but carries with it an increased risk to the offering company and its shareholders. A DPO has no underwriter, which means the company has to cover all the bills themselves. But it also means they don't have to pay an underwriter commission. Also, there's no set price when the shares go on the exchange and no guaranteed buyers lined up, so the amount of capital raised for the company could be significantly less than expected. Neither an IPO or a DPO is inherently better. It's up to each individual company to decide what best fits their long-term goals. But enough about how shares are created. Let's get back to investing in shares. Okay, so you've gotten over your missed opportunity with Protein and you're ready to give investing another shot. You find a company that you like that's recently launched an IPO and you buy a few hundred shares of common stock. Congratulations, you're now the proud owner of a tiny slice of a company. You may be thinking, when do I get the show to CEO my 15-step plan to become the next Amazon? Or where exactly is the private jet parked anyway? I don't want to break your heart, but being a shareholder doesn't actually give you any rights to use company buildings, equipment, materials, or access to any company property at all. Companies are considered legal entities all by themselves, so they technically own everything mentioned, not the shareholders. This can work in your favor as well, though. A company's debt is also not tied to you in any way, so if the company loses money or goes completely under, nobody will be knocking on your door to collect. In the event of a bankruptcy, whatever assets remain of the company will be liquidated and investors of the company will be paid until nothing is left. As a common stock shareholder, though, you're at the very back of the line, so more than likely you won't receive much, if anything at all. Alright, I can't end on that side of a note, so we're going to talk about two more possible situations you may encounter as a shareholder. Mergers and privatization. If you own stock in a company and it's bought out or merged with another company, one of two things happens to your shares. The new company can give you cash for your shares, or they can exchange your shares for some of their own. It's pretty common for a mix of both to occur, so you'll most likely get some shares and some cash. Now, if the company you own shares in wants to privatize, that means they want to convert back to a non-publicly held company. In order to do this, they must buy back every share currently issued so that they can be removed from public exchanges. This usually has to pass a vote, but it doesn't have to be unanimous, meaning you could end up being forced to sell your shares. Although, to increase the odds of a successful vote, companies usually offer a premium during privatization, so you probably won't mind. Okay, we covered a lot, so I think I'm going to wrap it up there. I hope this helped you better understand stocks in a general sense at least. If you have more detailed inquiries, Investopedia is a great resource, which I'll link below in the description. If you have suggestions for future topics, or if you just want to let me know which picture was your favorite from this video, drop a comment below. I'll be planning future videos largely off of your recommendations, so don't be shy. And of course, if you like this kind of content, please like, please subscribe. You'll be the first to know when I release another video. Thank you for watching.